Alright, so now let's actually try to account for the journal entries that go into each of these events. So we'll start with the first one. So we know that Johnny's dad gave him $20. In this case, we gained $20 into our cash account. But if we look at the second entry right here, it says that he also told Johnny that he has to give the money back. So if we can debit the cash account, so let's debit the cash account for $20, and since we have to pay it back, that would create an accounts payable account. It creates a liability account, an obligation that we have to return the money once we are able to pay it off. So if we debit the cash account, we have to at the same time credit the accounts payable for $20. Okay, so that's our first journal entry right there. The next one is that Johnny bought $20 worth of lemons. So lemons are the actual product that we sell, so we can classify it as our inventory. Now, since he bought it with cash, we know that he gained inventory, but at the same time he lost cash through that transaction. So we can debit inventory for $20 and then credit cash for another $20. Okay, so the next transaction is a little bit tricky. It's actually a two-part transaction, and it will make sense once you see the entire transaction listed out. So Johnny sold the lemonade for $40. So we know that $40 of cash came in. Now, a common mistake that people make is that at this point, they'll say that, oh, it cost us $20 to buy the inventory, to buy the lemons, and so I should credit inventory for $20. But you see, in that case, we'll have inventory for $20. We'll have $40 in our debits and $20 in our credits. And this doesn't work because in accounting, our debits always have to match our credits. We always have to balance our entries. In this case, instead of actually crediting our inventory, we'll credit an account called sales. And we can accurately write 40 because that's how much we sold it for. Now, in the case of our lemonade, we can simply debit another account called COGS, and this stands for the cost of goods sold. So the cost of goods sold, how much were the cost of goods sold? Well, they were $20, right? They were worth $20. So we'll debit this account for 20, and that's where we can get rid of our inventory by crediting 20. As you see here, that now the accounts actually balance and they actually match. So lastly, Johnny paid back his dad and took $20 out of the business. So this is another two-part transaction. They should have been written in different bullet points, but too late now. So the first thing that happened was that he paid back his dad. So let's actually debit our accounts payable by 20, and let's credit our cash account by 20. So what's happening here is that usually when we debit an account, it increases, but that's only true for assets. It's only accurate for things like cash and things like inventory. For something like a liability, like an accounts payable, when we're debiting it, we're actually reducing it. Because if you look back up here, for the accounts payable here, it increased when we credited $20. So over here, by debiting $20, we're actually decreasing the amount that we have to pay back. And in the same case, for cash, we're decreasing it when we credit $20. So this again balances and it matches out. And the last event is that Johnny took $20 out of the business. So if we go back to the earlier transactions, we see that we made $40 in sales while the cost of our goods was only $20. So 40 minus 20 would give us 20, our net income. So normally accountants at this point would go through closing entries so that they can actually take this net income and put it into an account called retained earnings. But for the simplicity of this video, we're just going to assume that the retained earnings account has already been credited with the $20 because the retained earnings account is a credit account. It increases with credits and decreases with debits. So we're going to assume that the $20 net income we made is already in that account. So in order for Johnny to pay back his dad, in order for Johnny to take $20 out of the business, we would have to debit retained earnings by 20 and credit cash by 20. And there we go.